institutions are able to come up with if there is a cause and effect, but not, it's playing itself out now.
It's an incredibly good point, Betsy, which is that if people concerned about ability of an entity to pay money back, then their borrowing costs are going to go up. Your point about chicken or the egg, so if the spread on the credit default swap goes up and thus pushes up the borrowing costs for a corporate or an entity, a borrower, that simply generally indicates the concern about a borrower's ability to pay the money back. And whether it's expressed in the coupon of the the loan or the bond, or whether it's expressed as a credit default swap, the fact remains that investors are concerned about the creditworthiness of that entity.
I have two more questions. I really appreciate you taking your time. I know it's getting late in London and it's almost dinner time in New York, but I have just a couple more questions if you can hang in there with me.
Sure.
Several things came to mind in reading about credit default swaps. One was, since it is a form of insurance contract, why can't we call it a form of insurance? Why wasn't it introduced as a form of insurance?
It's a good question. There's history to that. So the main driver of calling it a credit derivative was that they were introduced for banks to manage their balance sheets, to be able to buy and sell credit risk without having to buy and sell the loan itself. And in the U.S., banks and insurance companies are regulated as completely different entities. And as a result, banks needed a product that they could trade. Banks can trade derivatives. Banks can't trade insurance products. So they needed to create a product that was different enough from the insurance product that it could be called a derivative and traded by banks. And the key legal distinction between a credit derivative and an insurance contract, insurance product, is that in the world of insurance, you need to generally prove loss in order to get paid. For example, you have an accident, you have a car wreck, have to go and get a mechanic to come and tell you how much it would cost to fix your car so that you can prove to the insurance company that you will actually lose money because you have to fix your car, and as a result, they'll reimburse you some amount. Pay you when you experience loss. A credit default swap, because you are allowed to go short with a credit default swap, as we've just discussed, without actually having any risk, you loss yourself. So I buy protection from you on IBM. IBM goes bust. You pay me even though I didn't lose any money. Means that it's not an insurance contract. It's a derivative. I can go short as well as going long, obviously.
Very complex. Very different, and it was very clear from the way you're describing it. And my last question...
Can I just say one thing?
Yeah, go ahead, Ellen.
That has been pointed out as the problem with derivatives, that because you can make money off your house burning down, you have an interest in actually seeing it burn down. And a case has been made, that Goldman Sachs helped various entities collapse because they had bets on them collapsing. Not a good situation.
Well,
I think you spoke to that, didn't you, Terry?
I think we discussed that.
Yeah.
I find it hard to imagine how any one entity is large enough to cause other entity to go bust because they have a bet against them. To be fair, I'm by no means am I going to say that everyone that operates in the financial market is a good and honest soul, and that applies to any industry. But I would say that kind of behavior really be frowned upon in terms of the usage of various financial instruments. I mean, I think would hope that it would be frowned upon because that sort of behavior does sound pretty nefarious and pretty distasteful. And it's unfortunate that there are even rumors of that kind of thing occurring because it ultimately, if it is occurring, it ultimately is what is giving a bad name to the entire industry. And at the end of the day, it's frustrating because this is an industry that that has its roots in good balance sheet management for banks as opposed to risk-taking and, nasty business, as you've just described. So
if you want to read good articles on it, read Matt Taibbi's recent articles in Rolling Stone. They're very, very engagingly written.
The last question I had was I had done a piece with Bruce Weissman, who's doing a movie called Crisis by Design. And he brought together a lot of different facets of the wheel of complex causation that have to do with the takedown of the international financial community and the economy as we know it. However, there was a piece that he talked about a law that came out of the Bank of International Settlements in Basel, Switzerland, an accounting rule called mark-to-market. Terry and Betsy, are you familiar with what that is? And if you are, can you explain it to the public?
Next to credit derivatives, it's only the next most talked about kind of rule in the world of financial markets. Mark-to-market is how we operate across the entire financial marketplace. And we distinguish a bank's balance sheet generally between assets that we mark to market and assets that we don't mark to market. And the reason we do that is we say, look, these assets we're going to hold until maturity. So we own this bond until it matures. We're never going to sell it or trade it or anything. And these assets over here, trade them. We need to mark them to market because every day that we could decide to trade them, we could either make a profit or a loss on them, so we should be constantly updating whether we're making a profit or a loss so that if we do decide to sell them, that it's not that it's not a kind of a windfall gain or a windfall loss. It's been recorded already, if that makes sense. So we keep track of what the value of these assets are because we could trade them, we could sell them any time.
Why is mark-to-market considered a kind of financial demon?
Many people believe that it unnecessarily creates volatility in the valuation of primarily the banking assets. So markets go up and down. That's what they do. There's no magic that says they should always go up. There's no rhyme or reason to how they behave, but they go up and down. And so if you are forced to mark all of your assets to market, it means that the value of the things that you own goes up and down as well in your reporting of it. And what makes a bank look more volatile in terms of its earnings because it has to constantly mark assets up when the price is up or mark them down when the price goes down. And if your capital function, how much capital you hold is a function of the mark-to-market of your balance sheet, then your capital will fluctuate wildly as well based on the market. And so it just makes institutions look as stable and a lot more volatile in terms of their earnings and their capital ratios and requirements.
Are they forced, these institutions, to sell at a lower value than they ordinarily would have in the mark-to-market scenario?
It doesn't force any institution to do anything.
Okay.
But I guess in the extreme, if you say, look, you've got to put up more capital against this because the value is going down based on the mark-to-market, then it could have the effect of forcing institutions to just sell once they hit a certain threshold, as opposed to putting more capital against something.
Do you like mark-to-market? Are you comfortable with it?
I think that there are some assets that are easy to mark to market, and there are some assets that are not so easy to mark to market.